The Fed's preferred inflation gauge climbed to 4.1% in May, its highest level in more than 3 years. Core inflation also accelerated to 3.4%. The hotter than expected data could push the Fed to keep rates higher for longer or even consider another rate hike later this year. So let's bring in Robb, an economics editor at MarketWatch who covers the Fed. All right, Greg, let's get right to it. The report shows inflation moving in the wrong direction. So how does this change the outlook for the Fed?
I think it raises the likelihood that the Fed will hike rates this year. It would be the first hike since 2023, and it's a big sea change from a couple months ago when everybody thought the Fed was going to be cutting rates.
Yeah, I think that was the hope, right? We also saw first quarter GDP growth revised higher to 2.1%. So what does that tell us about the health of the U.S. economy right now?
That number was a little bit misleading. It did rise, but the reason for the rise was because the US imported less goods than people thought. So it's kind of like a statistical noise a little bit. We think the economy is growing in like the 1% range, 1.5% range. Consumer spending is kind of struggling. We're still seeing that have been spending a lot of money on gasoline because of the war. And so we think that the consumers are running into trouble here. The big growth in the economy is coming from the business side, a lot of AI spending. So the economy looks a little bit okay. The inflation doesn't look great. And that picture is why we think the Fed is sort of like leaning towards hiking rates. We're not sure. We don't know when, but the sense is that they probably might raise rates this year.
All right, Robb, thank you.